I'm Carlos Halandoni. I'm the head of equity and credit research for BPI Asset Management Trust. Today on Smart Money, we're going to be talking about the Fed and the BSP. In particular, interest rate policy for the next 6 to 12 months. As I've been saying all along, the outcome of both the FMOC meeting and the Monetary Board meeting for the month of June, i.e. last week, will pretty much dictate interest rate policy for the next 6 months and possibly up to the first quarter of next year. We weren't disappointed. As a result of last week's Monetary Board and Federal Reserve FMOC meeting, i.e. the Fed's meeting, we pretty much have a good handle now on how interest rates will be managed both locally and in the US in the next 6 months and possibly up to the end of March of next year. To start off with, we pretty much know now that the Fed is actually more dovish than people expected, and the BSP is actually more hawkish than people expected. Meaning to say, interest rates, at least locally, are definitely going to go up by the end of the year, while interest rates in the US will actually go up less than what people expected by the end of the first half of 2015. Now, what does this mean? It means effectively the peso will strengthen against the dollar at least up to the point or until the Fed provides greater, stronger signals that it will begin to raise interest rates next year. Not just raise interest rates, but when next year. Up to that point, the BSP will be seen as preempting the Fed, and the peso should strengthen against the dollar. So, having said all this, we see the peso ending the year at 44.4 by the end of 2014. What else did we learn from the FMOC and the MB meeting last week? We learned that the Fed was more dovish, or other way, less hawkish, while the BSP was more hawkish. But there was another issue: the inflation pressure that's building up in the local economy. The BSP chose to raise SDA rates by 25 basis points. Now this is interesting because all along they've been signaling the market that they were going to tighten due to what they felt was an excess level of liquidity in the financial system. But the fact that they used the SDA rate to try and reduce the liquidity in the financial system sends a pretty strong signal that not only do they want markets to start reflecting higher interest rates, but that they also felt that there was a need to slow the economy. Inflation pressures are building up. More specifically, food inflation. The culmination of typhoon-related price pressures and also structural reforms that are currently taking place at the Bureau of Customs are causing food prices to rise, faster than what people expect. Subsequently, the central bank felt that they needed to step in and to slow the economy. Why? It's because if they don't slow the economy now, the inflation pressure will only build up. More importantly, it will be more difficult for the central bank to maintain its inflation target for next year, which is 2 to 4%. In my mind, what the central bank was really trying to avoid was the situation of runaway inflation. And to be honest, before the SDA increases, this was very much on the table. You had the combination of rising food prices, and on the other side, you had excess liquidity in the financial system. excess liquidity, you ask? Well, there is excess liquidity in the financial system. In real terms, investors like you and I are getting negative returns from your investments. You basically have time deposits yielding you 0.8% and against a backdrop of inflation of about roughly 4%. Negative real inflation caused by excessive levels of liquidity in the financial system. So if you add that on top of cost pressure caused by typhoons, cost pressures caused by structural reforms, the Bureau of Customs, you have the recipe for runaway inflation. This is what the central bank, at least in my mind, wanted to avoid heading into the end of this year and heading into 2015. Having said that, the fact that SDA's rates rose by 25 basis points, and in our view it'll raise by at least another 25 basis points by the end of the year, it implies that the economy will have to slow. How much, you might ask? Well, we're still calculating it. But one thing is for certain. The economy will not grow 7.3%